Today, cutting the Trans-Tasman cord. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Westpac has operated over the ditch since 1861, setting up to serve customers in the Otago goldfields when it was known as the Bank of New South Wales. But now Westpac has hired Macquarie to help it decide whether to divest the bank of its New Zealand operations. The unit is a big player in its market with 103 billion New Zealand dollars in assets and making around 650 million New Zealand dollars cash profit last financial year, and it includes banking, insurance and wealth management operations. With over 1 million customers, the bank has nearly 20% of New Zealand's consumer lending and is one of the Kiwi Big Four banks. The news, which was first broken by the AFR Streetwise column, comes after sales recently in PNG and Fiji last year. And the Reserve Bank of New Zealand told the bank, along with other systemically important banks, that it will have to increase its Tier 1 capital requirements to 16% of weighted assets. On top of that, yesterday, the Reserve Bank of New Zealand told Westpac to order 2 independent reports to assess its governance processes after it had experienced ongoing compliance issues. So let's look first at what the Reserve Bank of New Zealand said. The Reserve Bank of New Zealand has raised concerns around Westpac New Zealand's risk governance processes and has instructed the bank to commission 2 independent reports to address them. We're experiencing ongoing compliance issues with Westpac New Zealand over recent years, most recently involving material failures to report liquidity correctly in line with the Reserve Bank's liquidity requirements. Furthermore, the bank has continued to operate outside of its own risk settings for technology for a number of years, Deputy Governor and General Manager of Financial Stability Jeff Buscard said. Westpac New Zealand needs to take a close look at its risk governance practices. To ensure this happens, we are requiring them to provide an independent report that assesses Westpac New Zealand's risk governance processes and practices applied by the Westpac New Zealand Board and Executive Management. And the Reserve Bank has also required that Westpac New Zealand provides a separate independent report to provide assurance that the actions they have taken to improve the management of the liquidity risks and the culture surrounding it are effective. Until the Reserve Bank is satisfied that Westpac New Zealand's remediation work is complete and effective, it is increasing the bank's required holding of liquid assets, that's cash, or assets that can be easily converted to cash. The independent reviews come under Section 95 of the Reserve Bank of New Zealand Act 1989. This gives the Reserve Bank the power to require a bank to provide a report by a Reserve Bank approved independent person. And the Reserve Bank will now work with Westpac New Zealand to implement the findings. And it's important to note that the Reserve Bank is confident that Westpac New Zealand's current liquidity and funding positions are sound and that the bank is well capitalised. The reviews outlined today are to ensure this remains the situation on an ongoing basis. And in detail, they found that Westpac New Zealand was found to be in breach of the requirements of the Reserve Bank's liquidity policy, that's BS 13, which requires compliance with minimum mismatch ratios. The mismatch ratio is a measure of a bank's liquid assets adjusted for expected cash inflows and outflows to mitigate risk during a period of stress. And Westpac New Zealand was non-compliant with its liquidity requirements because it was not calculating its mismatch ratios correctly. This had a material impact on the bank's mismatch ratios, with the non-compliance occurring from 2012 to 2020. The calculations have since been corrected, and Westpac New Zealand has progressed a program of remediation to address the root causes of that non-compliance. But until the Reserve Bank is satisfied that Westpac New Zealand's remediation work is effective, Westpac New Zealand's required holding of liquid assets will be increased via an overlay on their mismatch ratios. And in a statement, Westpac New Zealand said it would comply with the Reserve Bank New Zealand's instructions to carry out the reviews. Westpac New Zealand will also act promptly on any recommendations from the reviews, and we've taken steps to improve risk governance, but recognise that more work is required and support the additional oversight that the independent reports will provide. Now, the AF Street Talk led the potential sales story. Westpac Banking Corp has hit back that the Reserve Bank of New Zealand's move to load up Australian banks with extra costly regulation and capital, revealing that it may exit the country. The day after Prime Minister Jacinda Ardern said further action was required to cool a runaway housing market, Westpac confirmed a Street Talk report that it had appointed an advisor, Macquarie Capital, to consider decoupling its New Zealand subsidiary. Westpac's New Zealand business recorded a 38% fall in cash earnings over the 2020 year to $612 million. At Westpac's forward price to earnings multiple of 14.7 times, the division could be worth around $10 billion as the bank considers a demerger that would list it on New Zealand's exchange. Any decision to exit by Westpac, which traces its history in New Zealand back 160 years, would be a direct response to the Reserve Bank New Zealand's attempt to build a financial moat around the economy. The big four Australian banks, which have captured an 85% market share, have been hit by the central bank's edict that they would hold an extra 20 billion New Zealand dollars in capital to be built up over the next 5 years, the toughest capital requirements in the world. RBNZ Governor Adrian Orr said in 2019 that the move was prompted by concern that New Zealand might not be able to rely on Australian taxpayers to bail out the New Zealand banking system if a crisis hit both economies. This presented a big risk to the New Zealand economy. Westpac directly pointed a finger at the RBNZ in its statement on Wednesday, which said, given the changing capital requirements in New Zealand and the Reserve Bank New Zealand requirements to structurally separate Westpac's New Zealand business operations from its operations in Australia, it is now appropriate to assess the best structure for those businesses going forward. Others could follow, because analysts say Westpac could trigger a similar exodus by other Australian banks as operating costs rise. The development comes as Westpac retreats from the Pacific region. It shut its operations in China and Hong Kong last year, following the international pullback by other Australian banks, although ANZ maintains a strong institutional presence in Asia. Street Talk's report that Westpac New Zealand could be decoupled from the mothership came on the day that RBNZ Deputy Governor Jeff Bascard said Westpac subsidiary New Zealand needs to take a close look at its risk governance practices. Now, the Reserve Bank of New Zealand would need to approve any Westpac sale or float, and it's unclear how the central bank's demand for it to lift risk governance would affect the processes. Westpac is not the first Australian bank to signal a reduced presence across the Tasman in response to what is seen as an overly punitive regulatory regime, given the demands of the Australian Prudential Regulatory Authority for the banks to remain unquestionably strong. ANZ and NAB floated the prospect of rationing capital and reducing investment in the country in 2019. Jefferies analyst Brian Johnson said the announcement might be the first of many, saying it no longer makes sense for any Australian bank to own a New Zealand one. Mr. Johnson cited higher New Zealand capital hurdles, restriction on dividends, and lending restrictions as among the chief catalysts. Westpac is asking whether having operations in New Zealand is an optimal use of shareholder funds. He said it may not be the last bank to do so. And possibly there are hints of an anti-Australian bias. The Australian and New Zealand trading relationship is as close as that of any other two countries in the world. But for the past 20 years, New Zealand has pushed for Australian banks to provide more formal protections for its economy, which is unusual in not having a large domestic banking entity. Kiwibank remains a minnow. The Reserve Bank of New Zealand does have a very autarkic approach to prudential policy. There have been hints of an anti-Australia bias there, said Jeff Mortlock, director of Mortlock Consultants and a former chief staffer at the Reserve Bank of New Zealand and APRA. He said Westpac's move could send an important signal to the New Zealand government that one major bank and it is not alone, has concerns about the effect of the capital requirements and other regulatory approaches, including the increasing use of macroprudential policies for the purposes of correcting the housing market, which will also impose costs on banks. Westpac may be the first of a number of banks to speak out and say everything has a consequence, and piling regulatory constraints and costs on us mean we will have to rethink our appetite for being in this market, especially in an environment where banks globally will be under profit constraints for some time to come, Mr. Mortlock said. Although Westpac New Zealand might be too large for Kiwibank or the New Zealand superannuation fund to buy, the sale to a quality foreign bank could be another option that would also please the Reserve Bank of New Zealand by reducing Australia's dominance of the banking system. A spokesman for the Reserve Bank of New Zealand said any decision made by Westpac to exit the market was a commercial matter for the bank. However, a sale or transfer of ownership would require its permission. Our role in such a transaction, if it proceeded, is to assess it from a prudential financial stability perspective and, if satisfied, providing a non-objection notice under BS 9 and BS 15 of the Banking Supervision Handbook, the Reserve Bank of New Zealand spokesman said. In 2001, New Zealand forced Westpac to turn its local branch into a legal subsidiary to give the New Zealand government more control, and in mid-2013, New Zealand's open bank resolution policy required Australian subsidiaries to pre-position for a formal separation from their parents in the case of a financial crisis. The aggressive approach continued in December 2019 when the Reserve Bank of New Zealand confirmed that it would require Australia's big banks to lift their Tier 1 capital ratios to 16% of risk-weighted loans, or an extra $20 billion in New Zealand to be held in New Zealand. And in its statement on Wednesday, filed with the ASX 47 minutes after the Street Talk report, Westpac confirmed that it was assessing the appropriate structure for its New Zealand business and whether a demerger would be in the best interests of shareholders. Westpac is in the very early stage of this assessment and no decisions have been made. This will also consider the impact of the Reserve Bank of New Zealand's reviews, which were announced today, it said. If it does decide to quit New Zealand, that will be consistent with a withdrawal from the region more broadly. In December, ASX-listed PNG Bank owner Kinana Securities brought Westpac's Pacific unit for up to $420 million, and in October it said it would exit operations in Hong Kong and mainland China and cut staff numbers in Asia by up to 200 as it looked to cut costs and improve capital efficiency. Evans and Partners analyst Matthew Wilson said any decision to demerge and list the business in New Zealand, it was understandable given its revised focus on core banking services, an emphasis the new chairman John McFarlane has brought. So no surprises there, Mr. Wilson said. A demerged New Zealand business would be very well supported by the local institutions. The return on equity in New Zealand in 2020 was 8.9% and is expected to fall as higher capital is built up. New Zealand returns were higher than the group ROE of 3.8%, which was hit by pandemic-related provisions and impairments. As Australian returns recover, demerging a lower returning New Zealand business would lift the overall return of the group. Westpac's stouch with the Reserve Bank of New Zealand is the latest in a series of conflicts between the regulator and Australia's big four banks under Mr. Orr. In 2019, the Reserve Bank of New Zealand revealed that the ANZ had been running unapproved capital models. Going back 5 years, ANZ was handed a $277 million capital penalty and ordered to appoint an independent consultant to review its systems and processes. NAB was similarly penalised and handed a $250 million after it discovered errors in reporting risk-weighted assets over 3 years. But it might not end there, for as the AFR also said, when one big four bank moves, its three rivals tend to follow. In 2015, we saw it with equity raisings. National Australia Bank topped up its balance sheet with a $5.5 billion deal in May, and within 6 months, all three rivals had all done the same. In 2016, it was life insurance. NAB went first when it sold a controlling stake in its MLC Life to Nippon Life, only to see Commonwealth Bank of Australia offload its business to AIA, ANZ to sell to Zurich, while Westpac has JP Morgan's bankers trying to do the same. Then it was wealth. ANZ sold OnePath to IOOF in a deal signed in 2017, only for CBA to stitch up a deal to sell a majority stake in its colonial first state to KKR, and NAB to also offload its MLC wealth to IOOF. Westpac has its wealth assets under review as part of the up-for-sale specialised business unit. Likewise, their offshore investments, where there had been plenty of deals, among them NAB offloaded US-based Great Western Bank in 2014 and spun off UK-based CYBG in 2016, while ANZ Banking Group sold a bunch of its Asian businesses to Singapore's DBS in 2016, while CBA divested stakes in Asian and African investments including BOCOM Life and Time Digital, and Westpac recently jumped out of the Pacific. If you go back further, you can map the banks getting into and out of various assets at very similar times for, well, decades. So with the Big Four boards and management teams all banging on about returning to their core Australian banking operations, and for the time being at least finding favour with investors, the writing is on the wall across the Tasman. Westpac was the first to move. Frustrated by mounting capital requirements in New Zealand and other issues, it's drafted in Macquarie Capital's bankers to run a scoping study, and it will consider spinning the business off via a demerger or IPO or a sale. And you would have to think Westpac's three Australian rivals are having all sorts of similar discussions in their own tall towers in Melbourne and Sydney. The three Australians happen to own the three biggest banks by assets in New Zealand: CBA, ASB, and NAB's BNZ, are marginally bigger than Westpac's, while ANZ Banking Group is the market leader with $179 billion in assets. Together, those big four account for 85% of the banking market. It'll have investment banking teams with on-the-ground Kiwi operations. Even more excited will be those with substantial equity desks that could oversee a demerger or IPO like Macquarie, UBS, Goldman Sachs and Jarden. The bank's Kiwi businesses are chunky, or likely perhaps $5 billion or more. At ANZ, for example, New Zealand housing loans account for 13.3% of its total loan book, according to Morgan Stanley analysis. For the others, it's 7.2% to 7.3%. Well, I think we should wait and see if Westpac is playing chicken with the Reserve Bank of New Zealand, or whether they are serious about the potential exit. If they are serious and others follow, their beneficiaries might well be players like Kiwi Bank, New Zealand Founding Community Bank, or another foreign bank. On the other hand, the sale of the entity to other investors may not shake the banking foundations that much, actually, and would also provide Westpac with another step along the road to its simplification agenda, which, by the way, means becoming a more and more massive Australian building society with mortgages at its foundation. In fact, all of the big four are fighting on that plan at the moment. But it would be, of course, putting even more eggs in the property basket, and I've got to ask, is that really such a great strategic move? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.